Hi, we're going to talk about velocity banking. This idea is absolutely horrific. We're going to go over a video. I'm going to show you the math on why it does not make sense to do this thing at all. Okay. There's a video out there called Can You Save $69,000 within 24 months? You can with this trick. Hashtag mortgage, hashtag death note. Death note. Okay. Let's watch it and then we'll grab the data from the video, throw it in the spreadsheet. Let's see. Is it really that good?
So let's talk about it. If you have a $10,000 line of credit and you decide, hey, I want to put this down on the principal of my home, how much interest would that save me if I put $10,000 on the principal of my home? So we take the $10,000, we put it on the $500,000 home, and let's just say that our payments begin July the 1st of 2023, okay? So you take the $10,000, you put it into the home, and you're at $490,000 now. Now remember, you're still making your mortgage payments without taxes and insurance. The mortgage payment on this loan is $3,441.46 a month. It's just a baby payment, but you got this huge home, right? So you brought the $10,000. Now your home balance is at $490,000. What if you just decided to go ahead and make the payments on that mortgage and just see how long that took you to get to $490,000? Well, if you paid your payments for 23 months to June 1st, 2025, you are going to be at $490,000 balance approximately. So it took you 23 months to get there, making $3,441 in payments every month, right? But how much interest did you pay to pay that 23 months? So if you take the $10,000 and you put it directly on the $500,000 home, when is it $490,000? Today, July the 1st, 2023. When your first mortgage payment is due, you took the $10,000, you put it on your loan, you're now at $490,000, and it didn't take you 23 months to do it. But how much interest did you pay on this? I mean, this is a 12% line of credit, right? Let's see. So 10,000 times 12% equals what? $1,200, right? Now remember, that's a year. This is simple interest. So 10,000 times 12% is $1,200 a year. Now, what if you said, well, I'm not even going to pay on this. I'm just going to leave that sitting at $10,000. I'll just pay the interest every month. And yeah, it's like $100 a month, right? So if you divide 1,200 by 12 months, you're going to get $100. Yeah, I don't even care. I'll just leave it sitting there. Or you could take your income of $10,000. This person makes $10,000 in income, has $8,000 in expenses. He could say, you know what? I'm just going to use this line of credit as my checking account, and I'm going to put my $10,000 in here. Well, what did that do to your balance as soon as you put in your income? Exactly. What is the payment on this line of credit?
And what are you supposed to do that? What are you supposed to do that month about your expenses? You take all your income, put it in. Oh, yeah, the line is paid. What are you going to eat? What are you going to eat?
Exactly. When you put in your income into a line of credit, you have just satisfied that payment. And how much interest is on this loan now that he has put in his $10,000? Zero, right? So yes, his expenses could come out of that now. He can pay his expenses, which is $8,000 a month. Use this account as his checking account. His income goes in, his expenses come out. He has put $10,000 on his mortgage, and it did not cost him another payment to do so. Now let's talk about what happened over here with the 23 months that you paid on the mortgage. Remember, it took you 23 months just to get to $490,000. Here you got there in one day. And if you decided not to pay it, you paid $1,200 a year, right, in interest? If you let this run through June of 2025, you are going to pay $69,230 in interest alone. Think about that. 23 months of these $3,441 payments, $3,000 of that is going to buy the bank a house. It is not going to pay for your home. Your little $400 here, that's all that's going into your home. $29,230. Oh, you paid $79,000 plus in payments for 23 months. But 69 of that plus went to.
All right, I think you get it, right? She's suggesting to get a line of credit and a higher interest rate. Doesn't matter. Basically, she's saying it doesn't matter what the interest rate, because there's another video that I made where she took a larger spread between the two, a 20% line of credit. And she's saying use that line of credit to pay down your mortgage, and like magic, poof, your liabilities net go down. This is what I want to start with here. So what she's suggesting in the beginning is kind of this situation here, right? She said that this person has a $500,000 mortgage, and she also said the house is worth $500,000. I'm going to assume that she meant $500,000 mortgage, which at 80% loan to value, I'm going to assume this person's asset, and I call it asset, by the way. I know there's a bunch of debate out there about whether a home is an asset or not. That's not the point of this video. I'll put in the asset column for the sake of this video, okay? Home is worth $625,000. You have a $500,000 mortgage, which she put, and she's making it sound like you just are focusing on just this one variable. Let's lower the mortgage to $490,000, and that should cut a bunch of expenses down, right? Obviously, it doesn't. You're putting a liability of $10,000 back in there. Your liability does not change. Okay, that's number one. I want to clear that up. Number two, very crucial here. Number two, the reason why it looks like this works is because she is ignoring altogether this net income, she calls it cash flow in other videos, this net income variable. So she's saying someone has an income of $10,000, expenses of $8,000. There's an extra $2,000 there, right? Well, in her velocity banking metric, she's saying take the entire income to pay down that second loan. Okay. That's where all of this kind of like collapses. If you're going to do that, you might as well just go and pay off the extra with your extra income towards the principal of the original mortgage. And I'm going to show that to you. Okay. But to continue with her argument, take $10,000 out, put $10,000 towards it, take out $8,000 because you got to live. You know, you want to go see a movie or pay for Netflix, buy whatever, food. You like food? I like food. Okay. And you then have an ending balance, you pay an interest on that, and you do it again the next month. Okay. In her example, you will pay down that $10,000 in 5 months. Okay. There's a little bit of a balance left over of $206 going into month 6. I am ignoring that extra. I'm going to assume the person gets scrappy and pays it off, right? And you repeat and recycle this over and over again. Okay. Well, let's look how this looks. First of all, yes, she is correct on her math. The original loan, as is $3,444.86, $500,000 mortgage at 7.35%. That's without a question. She's correct about that. Her total interest, I think, came in around there as well, in line. Her velocity banking methodology. Here we go. Let's look at it a little bit more deeper and not just on a whiteboard where there's like you're just writing conclusions down. Let's actually look into this. Your payment stays the same. Your first month, right off the bat, you strike a check for $10,000 that you're grabbing from the line of credit, okay? And you do that every 5 months, as I showed that you're going to clear that out after 5 months, and you're going to have to redo it over and over again, right? When all is said and done, you've done 28 cycles of this. I call it chunks. We call it cycles, velocity chunks, velocity cycles, whatever. You're paying that much interest, $5,769.97 in the velocity portion of the interest, plus the interest that you paid on the mortgage during those times. And your total interest is $237,682.42. Now remember, please remember this because this is crucial here. That extra $2,000 a month that you have left over is going all into this strategy. So why don't we just take the $2,000 and put it towards the principal of the original mortgage? Well, let's compare that. Okay, here's where we did this. I put $2,000 every single month in the original mortgage. Here's where we land. We pay it off in 136 months. We pay $237,046 in interest. How does that compare to the velocity method? Here's the summary. Velocity banking took you 135 months to pay down. Remember, you're doing the exact same motion. You're taking all your income, everything, which we can argue why that's not a good idea. Maybe there's some alternative use, opportunity costs, etc. That's not the point of this video. Is just to dissect what's going on here. The pay down $2,000 a month extra is 136 months. Woo! You save a month. You save that month. Cumulative interest on velocity banking, $237,682. Cumulative interest on principal, $237,046. So you pay $636 more with velocity than principal pay down at a spread between 7.35% on the mortgage and 12% on the HELOC. Now, I'll admit, when I ran the numbers, I thought the difference would be bigger, right? We're talking about 4.65% difference in the interest rate. However, as it turns out, the math, it's basically, call me crazy, no difference, right? 1 month, $600. So the argument becomes, why do this? Why do velocity banking? It doesn't make sense. So what does this mean? Let's go over the summary. The results of this is that there's anywhere from a marginally worse to break-even difference to much worse than principal paydown. It all depends on one's inputs, right? If you have a very low mortgage and you can only get a high line of credit, it's going to be even worse. This is probably as tight as it's going to be. Maybe, all right, if you were to go to 9% lock, I did that also. It's still very marginal different. The paydown's almost the same in terms of time, and the interest is about break even. Velocity, this is the big one here. I'm going to highlight this. Excuse me. We'll go blue. Velocity banking appears to work because in the method, Usually, one is putting all 100% of income, which includes the excess cash flow, net income, it's called net income, towards the loan repayment. Okay, that's just crucial. And then I'm not going to talk about every lock reality. I've talked about this in other videos, but I do want to focus again on the last one here because this is important. First, I'm getting the sense from the comments that some of these people are using this as a debt payoff method. Potentially they're in debt problems. And I'm going to argue for a moment. If somebody is in debt problems, is it a good idea to go get more debt? Okay. No. Again, they're going to do this maybe the first month because they're jacked up about it. They're like, woo, I got a strategy, baby. But the month 2, month 3, they might slip. They might go use some of that line of credit for something else, not towards the loan, towards the original mortgage. And that's where this gets snowball. All of a sudden, a year, 2 years of that, and all of a sudden they have an extra loan, extra liability that they haven't repaid. Okay. Use this with extreme caution or don't use it at all. Okay. I hope you get some value from this. Please do not do this strategy. It doesn't make sense unless the line of credit is substantially lower than your mortgage. But if that's the case, you can just go refinance the mortgage. Anyways, don't do this. All right. Have a good day. Bye.